Okay, so the next panel will be about trading in capital markets. One of the maybe the leading topics which I'm personally interested in, so I'm willing to listen to you as well. So I'm inviting to the stage the moderator, Mr. Dr. Johan Biderman. He's the managing partner of Biderman International Consulting. You're welcome. He's a highly experienced consultant in the financial industry. He acts all over the world. And also Mr. Virender Misra. He's coming here as the Chief Executive Officer and co-founder of Global Markets Exchange Group. You're welcome on the stage as well. And his group is focused on operating exchanges across multiple asset classes also. And Fahad Kamer and Flipkart. Okay, surprise to me. So you're welcome on stage as well. Flipkart also recently joined ULink as a global head of business development. So you're welcome on stage, sir, as well. He is Fahad Kam, and he's the founder of Market IQ. He has over 10 years of experience in the banking, strategy, consulting, and I think it's going to be fun. Thank you.
Introducing us, and I think I also speak for my distinguished participants in the panel. We are very glad to be here in Istanbul talking with you about what fintech and capital market have in common. So maybe to start a little bit and to make it later on a little bit interactive, I would kindly ask you to think about some tough questions. In particular, Hiranda is very keen to answer some of them at the end, so we definitely will reserve a little bit of time for this. When we look about capital markets and fintech, some of us have heard about robo-advisors. Some of us have heard about some fintech companies offering trade following, where you can copy the trade of another investor and I think follow the idea of other investors. But I think there's definitely a lot of more, and I hope we can talk a little bit about this today. But let me start looking a little bit at the exchange industry, which is at core of capital markets. And many people say, in particular from the exchanges, this industry has seen a lot of disruption in the last 20, 25 years. It started with the first exchanges going away from open outcry to electronic trading. Maybe these were the first, let me call them fintechs at the time, end of the 1980s. And then I think they passed a lot of more things, a lot of more disruptions, up to high frequently trading some years ago. And Hiranda, maybe let me start with you.
Sure.
You're also seen of some of the disruptors in that sense, is that right?
Yeah, I mean, not quite from the 80s, but certainly from sometime in the 90s, although I'm going through that Peter Pan moment right now. But yeah, I mean, as you spoke about, I mean, the LSE, the London Stock Exchange, for example, it was open outcry. Then in October 1986, it went to screen-based trading, albeit the markets weren't fully electronic, but you could actually see prices on a screen, so quotes on a screen. And then, I mean, typically in these things, back then, the cycle was much longer. So 11 years later, in October 97, it went fully automated with a central limit order book. And I remember when I started out, I mean, around 96, I mean, some of these, you had some of this innovation in the US, where some of these exchanges were open outcry, like the New York Stock Exchange, and some nimbler, disruptive trading venues came in. They called them ECNs, electronic communication networks, and they ended up being much cheaper to run, much faster, better technology, and they disrupted the existing exchanges, firms like Island, Internet, Archipelago, and took market share. And ultimately, the exchanges had to buy them because effectively they impacted the revenue models of those exchanges. And we saw a similar thing in Europe as well. I mean, when I started out, the markets were semi-automated, but you had the Paris market had something that you called a CAC man in line with the index. So you'd get an order on a screen. Typically it was Philippe, who was at GL Trade at the time. And you'd then have the exchange terminal, and there'd be a guy all day long putting in thousands of orders from one to the other. Surprisingly, very few errors. And then we ended up automating the whole thing, and then algos and HFT came in as well. So, I mean, we've seen all of that. We've seen this whole need towards really faster systems, but now I think we're moving towards more innovation driven by products, driven by underlying data, and technology being the enabler as well.
Philip, technology obviously is a core topic, not only in fintech, but also in general in capital markets terms. So in what direction you think this is developing, and what is your company doing in that sense?
Well, very much just to continuing on what Hiranda started. Basically, we saw all of that, and the company I work for provides trading technology exactly in that space around them, buy side to sell side, trading on exchanges, trading OTC markets, bringing instruments to be traded electronically and cleared electronically. I think what's interesting is probably we've gone through that first phase. I think a number of you might have been there when Peter Randall was introducing the conference, talked about these big waves, these big cycles of massive changes, SWIFT, real-time gross settlement system for banking. And then we saw for the trading very much the noughties, being the 2000 big changes, as Hiranda just pointed out, 1987, 1996, MIFID, pre-MIFID, but the first market directive in Europe giving pan-European access, MIFID 1, and then the great financial crisis. But all of these, followed. We are probably now just coming out of that first cycle of big technology change. And probably if I compare it to other sectors have had a much more continuous change, evolution in technology. We have had big changes in technology, which have slowly but surely slowed down. Yes, we've had HFT, collocation, changes of which products can be tradable on screen, the vast emergence of people connecting to emerging markets worldwide, the fact that the capital markets is really a global industry. But fundamentally, you can see that over the last couple of years, it had slowed down. Probably the great financial crisis, the regulatory onslaught, a number of changes happening in the capital markets. And you can see that now there is a second revolution probably coming. I'm not sure it's a revolution or a second evolution, but I would tend to think that we're just at the verge of a second cycle. It's not because something has happened at one point that everything stops. We are probably, things are going to happen because we spoke about we heard people speaking about blockchain this morning. Blockchain will change a lot of things, but probably not only on the post-trade. It will change things in the pre-trade.
In what sense?
In the way of you can now issue intelligent contracts which automatically generate actions. So you can do, when you do flotations, IPOs, you can automate some of the instructions that you are given. And we have yet to see how this is going to change. But blockchain is just one example. I'm sure we'll talk about big data analytics. That space is going to change a lot how people operate. I think the third one where you can see there will be a revolution is the fact I think most, or at least a lot of the business models that we see in the street are not sustainable. The chronic overcapacity in terms of trading capabilities it's not sustainable anymore. I think we will see much more people disappearing. You see people getting bigger. You see people choosing niche markets, niche products, staying there, becoming very good there, becoming unavoidable to trade there. I think the idea that you could become starting from a tier 3, become a tier 2 and become a tier 1, these days are over. We will see increasingly people disappearing along the chain, and that will participate again into that ecosystem.
Fahad, I think you're looking at, one of the products which is using big data, which is using social information with your company. Can you explain a little bit what you're doing there and in what sense it can make a change, maybe also for retail investors, right?
What we do is we focus on providing predictive intelligence based on different types of data sets. The focus is on financial institutions. So we tend to work with banks on the retail side, on the investment banking side. We tend to work with insurance companies, hedge funds, and stock exchanges. And it's interesting because when we talk about big data, within the capital markets specifically, it takes on an extremely interesting role. So when we are working with some of the larger financial institutions, the way we look at data is there is structured data and then there is unstructured data. So structured data is essentially, think of it as anything that's queryable. So anything that you can put into an Excel worksheet, put some formulas on it and get some results. So this could be your company financials, it could be your sales records. Unstructured data, on the other hand, is everything that's not queryable. So this is your analyst reports, news articles, blogs, social media data. And the trend that's being adopted within the capital markets across banking as well as across asset managers is the coupling of this data set. So we're looking at how is it that the internal structured data, which is your specific models, the external structured data, which is your pricing data, how do you use all those external and internal structured data sets, combine them with the unstructured data sets, and really the focus being how do you take this data and then transform this data to make it informational so you can understand, just to keep it simple, you can understand what's a company's price to earnings ratio. You can understand what's a company's debt to equity ratio. But then the direction that it's headed towards, what we're doing with a lot of our clients is really transforming that information to make it predictive, to make it cognitive in terms of providing insights. So it's really taking, we're seeing smart systems come to life, which are now looking at vast data sets and essentially predicting or surfacing an insight pertaining to an investment. And the focus is how do you enhance the overall decision-making process. Now, where social starts to come into play is if you take a step back and think about this, social media data actually provides a unique insight into customers' perception. Right? You have users or you have your customers that are talking about a specific product. You may have customers that are talking about a specific brand. When someone says, stood outside the Apple store for 6 hours to get the brand new iPhone, that's interesting, right? From a capital markets perspective, that's interesting. From a corporate perspective, from Apple's perspective, that's interesting. And then when you look at these various avenues or channels where user-generated content is created, it could be blogs, it could be Twitter, it could be Facebook, it could be comments. And when you couple all those interesting pieces of user-generated content and you run natural language processing on it, you run various self-learning or deep learning algorithms on it, what you end up doing is you end up taking all this unstructured user-generated content and transforming it into structured insights, which can then be used for investment purposes. And today we're doing this with a few of our clients. Our hedge fund clients use this, but now we're also seeing asset managers using insights from this unstructured data set to create investable products like ETFs and mutual funds.
Mm-hmm. And you have created an ETF out of this,
We've
right?
partnered with an asset manager to do that.
Hiranda, in terms of ETFs, we always see in the capital market space things which pop up at the sidelines and then sooner or later become mainstream. Thinking of ETFs, this started early with Nasdaq QQQ and so on. Yeah. First, only institutional investors focus on this, and later on, even retail investors, I think, are now making use of it. If we're now looking at robo-advice, I think some of the solutions offered consist of an ETF portfolio, which is created in a customized way, depending on the needs of a private investor, for instance. So I think if such things happens, more passive investment, maybe now more investment even in a small subset of ETFs, do you think that it's the right way of dealing with private investors, giving them a good offering? Or at the end, we are putting all eggs in one basket again? So what is your idea?
Well, I mean, you've got to ask as well. I mean, we talked about some business models being disruptive and others being disrupted. I mean, typically most of the research out there driving trading decisions hasn't necessarily been independent. Mm-hmm. Most of it's been created by the investment banks that maybe have some conflicts to some degree as well when they're kind of providing that research. So I know even back in the late 1990s, early 2000s, when I used to work for an agency broker, Internet, we used to try and seek out independent research. But the problem that you had then, whether it was the institutions or whether then it was the end retail sort of investor. Obviously, independent research required a lot of bodies to produce it. It wasn't being cross-subsidized by anything else within the business, for the sake of other banking fees. And when you tried to pass those economics back upstream, no one really wanted to pay for it. So they kept saying, yeah, we want it, and we were talking about this on a similar thing to technology earlier in the break, but no one quite wanted to pay for it. So now actually, markets are becoming more democratized than they were before. technology previously was to some degree a barrier to entry, but then, you can create exchanges now, well regulated with very low spend capex and very low ongoing opex as well. I've been fortunate enough to do that a couple of times now. But equally the same if we look at research and other products. The more you can automate this, and you've got to start with the simpler things, that then makes it more widely accessible to mom and pop and everyone across the market. And in turn, that then evolves as well. So that's got to be a good thing. I think that doesn't mean the need for, it's much like technology. The need for traders, doesn't necessarily go away, and the need for research analysts in this regard doesn't go away. But it's just a different type of skill set from there on in.
Mm.
I'd add to that. It's funny because we're almost coming full circle. Thanks to some of the advances of the financial technology to be able to identify, to probably not even identify, but to gather data and be able to analyze it, allows you to suddenly make much more decision by yourself without requiring the help and the need, the assistance of other people in the chain. And I think it boils down to what we're already talking, which is in that financial model of the capital markets. The first change that happened in terms of technology were very much trying to automate, trying to create technology that automated some of the workflows that human beings were doing. And so basically the first screens that came out, as Hirando mentioned, instead of doing this on one and then this on the other, so you learn piano very quickly.
Or having the long phone line. So
exactly.
10 meters.
You needed to have a swivel chair, to go from one to the other really quickly. And the best your swivel chair, the quicker and the more commissions you made. But I think if you think about this, a whole chunk of technology was very much centered around this. It's looking at a human, looking at a trader. How can you help him being more efficient? You're not talking about what is, the end game is not for the trader to be more efficient, is ultimately the end investor for him to get access in a cost-efficient manner to a market to help, find the discovery of a particular price of a particular security in time. But the first revolution was already that, the fact that the markets became electronic, then you need a clearinghouse. I think if you link it to the Turkish experience, the fact of putting all the exchanges under the same umbrella, creating a clearinghouse, setting up a model, or at least following a model. So basically, we've had that, and that was probably the first big revolution. The next one that is probably going to happen is a lot of the banks, a lot of the brokers, a lot of the sellers, and exactly what Hirando mentioned, a lot of the functions they used to do are no longer required, or they cannot provide them anymore because cost efficiency means that they cannot. They don't have the money to do this. There are not charities any longer. And this is an interesting point about fintech again, is the advance in technology in other areas, cognitive science, artificial intelligence, can then be brought into the capital market space.
To what extent, now we have talked about technology, to what extent trust is important? I'm coming from a country where many retail investors, they have their money on the bank account for 0 interest instead of even considering investing in the stock market. And the last thing they would consider is going to their bank and get advice there, because after the financial crisis, I think the advice might be a little bit biased.
A good idea.
Right? So to what extent new technology, in particular fintech offering, can create more trust? Be it robo-advice, which offers via internet a nice portfolio of ETFs, which might not be biased in a certain way. Or do you see other means? Any comments on this, on trust? Right.
So it's interesting because when you're looking at outputs provided by technology, there is a rules-based system behind it. So so there is no human bias in that. Now, so we have clients who are looking to build out a robo-advisory service in-house, and the role that we would play is we would provide them with the platform to do the intelligence in terms of how do you ask all the questions that you need to ask to understand your customer to satisfy the KYC requirements, and then the way the system is set up, it's really interesting. It's if you were to walk into a bank and you would have your banker ask you certain questions to understand you, the system is designed exactly the same way. The system is asking you the same questions, and but the interesting thing is the system does not have a bad day. The system never wakes up and says, I am going to think about these questions differently today just because my eggs were not good or whatever, right? So it's very consistent, it's very transparent, and then it becomes even more interesting because there is a self-learning component to it as well. So now typically when you're looking at any banker, and you think about the growth, and this pertains to almost all of us, right? We think about our personal growth. How much content are we ingesting on a daily basis across all the different verticals? There is politics, there is sports, there is business, there is banking, there is regulatory components. But then you truly don't get that chance to continue to develop your expertise within a specific vertical, just because you don't have that access, or you don't have the capacity, or you don't have the time to manage it. But when you're looking at a self-learning system, it continues to learn based on its mistakes. It's able to cognitively understand some of the things in the past which may have raised issues, which may have raised or led to crisis, how to draw those patterns, how to draw those trends, and how to predict when something is about to occur again, so you can actually save your customers' accounts. And that's where it becomes interesting, and that's the direction that we see a lot of our clients going into. Mm-hmm. Does that make sense?
Yes, definitely. Iranda, we are sitting here really at the core of the Turkish capital market. I think the exchange is literally in walking distance, right? So, and I guess the audience is very interested what can be expected here in Turkey in terms of changes, new technology, robo-advice, you name it, right? So what is your idea, and what should be done here,
So
I think, to encourage
this is
this?
a trick question. You might not be able to fly out of
The
the
more
country.
difficult question will still come, huh? The audience is still thinking about hard ones.
Sure. I mean, it's interesting if we just look at, I mean, Philippe mentioned the merger of the individual exchanges, because again, if we look at capital markets now and, cross-asset trading increasingly, because, when we speak about trading, let's say 10, 15 years ago, it was much more siloed, and actually, even 10 years ago, all right, you were doing an equity and then you were hedging using an equity derivative. I mean, that was considered sophisticated, but now trading is much more multi-asset, and whether, and there's some natural correlations, whether it's commodities with currency products and so forth as well. So to bring all that into a kind of single exchange umbrella, that's pretty progressive. And equally, when I started out on the broking side, I mean, the Turkish market, whether it was a technology was maybe behind the curve, or I remember you couldn't cancel orders on the exchange as well. It was one of those things, and that was manual. All that's changed, and you've got kind of the basis of fully automated platforms now, and I think that sets a tone. I mean, ultimately, technology is an enabler, and you need to develop a strong capital market from the ground upwards. I mean, as an example, I mean, we do a lot of work in emerging markets, with both business and technology across exchanges, and we're setting up the first stock market in Tajikistan. But when you spoke to the government and you spoke to other officials, they expected overnight miracles. They expected that all of a sudden you open a market and you're going to have lots of listings, and all of a sudden the economy is going to go from a small sort of economy with some degree of mining stocks and small and medium enterprises into something gigantic. And it's not an overnight story. Yeah. So I think, again, here there's a strong basis on regulation. Equally, the exchanges coming together has made this more holistic as well, and that set the basis for the market to grow. There's more foreign investors coming in, and effectively there's more trading firms. I mean, firms like Philippe's coming in offering services which sort of international investors as well as domestic ones can benefit from. And so that, I think that bodes well. I mean, again, I normally tell the truth about these things. I wouldn't sit here if I wasn't bullish, but I think it bodes well for the development of the Turkish capital market. I think also a lot of lessons can be learned because, I mean, we have a lot of these fintech hubs with some interesting hubs of innovation in London, and a number of firms, and you know, we were relatively new over the last 5 years. But equally, I think there's a real appetite here for some of those firms to come set up, increasingly go into more R&D rather than vanilla service provision as well.
Yeah. Philip, the high mobile adaptation rate here in Turkey, is it helpful?
Yeah, definitely be helpful. I think more on the banking side, but it probably helps some of the trading functions later on. I think what's probably more interesting is, Hiranda mentioned it, and Fad as well, basically is the acceleration of the cycle. You know, technology happens, and then the rate adoption gets better, and then the next wave gets off the ground much easier. I remember very well in the 90s, which is for most people in this room some kind of unknown time, where you didn't have a mobile phone. And I go to Malaysia, I think, and the guy who was serving us coffee had 2 mobile phones. I'm living in the wrong country, but it's just out there. So striking conversation. Just explained, but they didn't have. There was no way they would ever get a fixed mobile, a fixed phone. It's too complicated in Malaysia. It's going to cost too much. I think the official wait time was something like 12 or 13 years. So they just went to mobile. And I think what will be interesting in the Turkish capital market space is to see what's going to happen now that there's a regulatory framework, the exchange is there, collocation, all you can go through a tick box and list, and it's pretty much all there. As Hiranda mentioned, there's probably more of a listing story to happen. I think Boss someone mentioned they wanted to have 1,000 listings by the 100th anniversary of the Republic, which is coming soon. Basically, you've got to accelerate things a little bit at the exchange. But it'll be interesting to see whether the rate of adoption and whether we will see a faster rate of adoption of new trading techniques, things empowering the buy side much more into Turkey than we've seen. I mean, it's taking place in Europe is slow. The move from high touch to low touch, but it'll be interesting whether it's faster here. Because of this, because of the fact that you've got higher mobile adaptation, a younger population ready to fire up.
So it means also then higher risk of people bumping into each other at Taksim Square because they're not only texting but also successfully trading at the exchange, right?
Well, as long as it's on Taksim Square, they're just bumping into each other because they're just trading. I think that lots of people in Turkey would be very happy with that.
So now I would like to open for a question from the audience. Mustafa, you certainly have a question for Hiranda, haven't you? Maybe wait for the microphone.
Yeah, so the question was, Tajikistan is an interesting example. Why did we, as GMX, invest in Tajikistan? It's interesting because we're doing a lot of work in some of these frontier markets, whether it's Malawi in commodities, Tajikistan as a first stock market. And really, when the government came to us and we got introduced and sort of on the international trade development side, they were kind of saying, well, actually, we want to create a market in Tajikistan. And my first question was, why? I mean, it wasn't a bad question, but the thing is, some of these markets are so small, actually, that they don't necessarily need what they think is a traditional stock market because the economy can't necessarily sustain it, or it's at that evolution of development. Yet everyone's, even with exchanges becoming increasingly publicly listed, and we've seen this debate go on with Deutsche Börse and the LSE at the moment. They're still nationalistic in terms of, governments still see them as nationalistic symbols of identity. So typically when we went in, we thought, okay, the opportunity there isn't necessarily cash equities immediately, but actually it's government debt because, the government were borrowing money abroad, the economy was improving, but the credit rating that they were getting with S&P and Moody's didn't necessarily reflect what their actual credit rating should be. So they were borrowing money at a much more expensive rate than they should be. And so the first thing that we're doing there is developing a more developed, sophisticated government debt market and changing regulation in that regard, and doing some work where the EBRD are looking at how they come in as well. And for us, it's all about aligning interests. So, rather than just come in as a technology provider, we thought, okay, if we take a stake in the exchange, the clearinghouse, the depository, then we're in it for more medium-term upside as the economy grows. And of course, then a cash market will develop over time as well.
Yeah. But I'm still looking for a tough question for you.
Oh,
This one was much too easy.
That's too easy?
I think we have
You're
still
obsessed.
time for one tough question, or to Philip or Fahad, so whoever you want to choose, please. Ah, perfect. Thank you. Wait, the microphone is coming.
Algorithms are learning from their mistakes. If you're playing Go, you lose many matches. But if you are trading, you lose a lot of money. Your thoughts?
So that's interesting. It is interesting. But one of the things that you focus on, especially when you're building out these cognitively smart systems, is the focus on transparency, as well as the focus on testing. And the way the systems are set up is, because the reality is today you have tremendous amounts of data. There is no shortage of data. So as long as you have the data sets and you create the right tests around it, you're able to minimize the risk associated with such systems. Now, what tends to become interesting is even though it's a smart system, it's still exposed to tectonic shifts in the economy, as well as tectonic shifts in the data sets. There may be things that never happened in the past. So we've been looking at this data set. We started almost 5 years ago, literally spent the first couple years just sitting in the data dungeons, working on the algos, getting our patents in play. And then when we were looking at this market initially, this was 2013, Q3, Q4, we just started working with NASDAQ, and that data set wasn't deep enough, right? We only had, when you look at the capital markets and you're looking at pricing data or company fundamental data, you have 10 years, 20 years worth of data. But in our case, we're walking forward with 3 years worth of data, and it's nothing. And it wasn't, and the way we looked at it at that point was the efficacy of the data wasn't there for us to have the level of confidence that we do today in terms of how this can be applicable in terms of augmenting the investment decision-making process. But then you look at the growth in the data set from 2012, 2013 to today, and it's grown exponentially, and the depth of the data set now allows you to do all the different types of analytics that you need to do to mitigate risk.
Thank you.
Sure.
So I don't want to delay the lunch further, so
Everyone's hungry, right?
I would kindly ask you to join me giving a big hand of applause for my fellow panelists. And thanks a lot for listening to us.
Thank you.